Hey everybody, little error going live here. I'm not sure what quite happened there, but I think we're good. We will start in just a few minutes. It'll actually be a little faster than the timer says. You can disregard the timer. Be right with you. Hey, it's Jason Hartman, continuing with the 10 commandments of successful investing. So today, I want to talk to you about commandment number 9. Thou shalt only invest where there is universal need. You know, there's an old saying, people all have 3 common needs. What are they? Food, clothing, and shelter. Let them rent that shelter from you, right? Let them rent that shelter from you. Food, clothing, and shelter. So when we are real estate investors, when we are landlords, we're offering a fundamental, universally needed commodity, housing, shelter, right? Very, very important thing. Now, a lot of people out there want to appear more sophisticated. So they say, well, I don't deal with this little housing stuff. I'm in commercial real estate. I want to own shopping centers and office buildings and high rises and huge apartment complexes. Well, the apartment complex isn't part of it, actually. That's housing. Or they want to own an industrial property, right? Look, at the end of the day, the only thing everybody needs, and if our population is increasing, the only thing everybody for sure needs is a house, a place to live, a place to sleep, a place to call home, right? Let them rent that from you. Look at what's happened with outsourcing over the years, okay? Really since the early 90s, and maybe really inspired by Richard Nixon's famous trip to China in the early 70s, right? Maybe that was the start of it. We saw this massive push toward outsourcing. So we outsourced manufacturing to China, known as the workshop of the world. Now the tide is turning with President Trump, love him or hate him. Jobs are coming back to America. And listen, I have my qualms about Trump for sure, but I have always said he's going to be good for the economy and good for the American worker, which really hasn't had a pay raise in guess how long? 41 years. In 41 years, the typical American worker has not had a real dollar, in other words, adjusted for inflation, a real dollar pay increase until just recently. So that's huge. That's a big deal. So China, we outsource our manufacturing to, right? The workshop of the world is China, right? And so what does that do to industrial property real estate investors in the US? Well, it lessens demand for industrial properties, right? Properties where they manufacture things. Okay, then let's look at the retail apocalypse, as it's known, right? Amazon.com is leading the charge, destroying businesses, just destroying businesses. You look at shopping centers everywhere, whether they be, beautiful shopping malls or strip centers or big box, what's known as big box shopping centers with, formerly Circuit City, now Best Buy and Costco and these big centers, right? With the big box retailers. They're all having problems because retail shopping has largely been outsourced to the internet. So that market has become very, very depressed. In fact, it is a retail apocalypse. So we manufacture outside of the country, lessens the need for industrial properties. We shop online, lessens the need for retail properties. Well, what's the other big category? Office space. You guessed it, office space. Fortune 1000 companies and all the rest are telling employees to go work out of the house. And guess what? Employees like it, right? There's a great book by, I've interviewed him, I believe, on my podcast, Mitch Russo, called The Invisible Organization, which is about having a virtual company. Look, my own companies, we always used to have big, beautiful offices, Class A offices that cost $20,000 a month, or maybe more than that with all the affiliated expenses. And these offices, I used to think that was really important. And then when our last lease came up in Southern California, in Orange County, California, our last lease came up in 2012, we went virtual. You know why? I decided to stop fighting it. My employees and my staff didn't want to come to the office. They all wanted to work out of the house. And they'd come up with this excuse and that excuse. Can I work at home today? Whatever, right? And I thought, why am I paying for this office space? And why am I paying for this staff to be here, the receptionist, et cetera, right? Why am I paying for the coffee service that comes in and brings the coffee, and the water service that brings the water, and all this stuff, right? We'll just let people work out of the house. Lessens the need for office space. So office space has undergone a significant depression as well. At the end of the day, everybody needs a house, a place to live. In fact, I would argue that they need a bigger house now because they're working at home, right? They're working at home, a lot of them. Home-based workers, virtual workers, remote workers, huge trend, probably isn't going to go backwards anytime soon because it's enabled by what? Technology, right? We have video conferencing, we have all these tools, and not only that, there are all these tracking tools now to track and organize virtual teams, right? So it's a great deal for the companies, and it's a great deal for the workers. The workers don't have to spend their time in a car commuting. The environment doesn't get as much pollution. They get to eat what they want. They don't have to spend a fortune on lunch. They can be at home. They can be with their kids. They can go walk the dog. Folks, only invest in things that have universal need. Everybody needs a place to live. Now, on a future video, we're going to talk about something I call packaged commodities investing or assembled commodities investing. And what I mean here when I talk about this is that I don't even like real estate. I think real estate's overrated. You know what I like? I like commodities, but not in the way you might think, right? A lot of people think, oh, well, if I want to invest in commodities, then I'll go to the commodities exchange and I'll buy coffee or pork bellies or, whatever commodity, orange juice, doesn't matter what it is, everything's a commodity. You might buy precious metals, right? All of this stuff. But, I like these commodities to be packaged or assembled in the form of a house or an apartment building, right? Think of it. All these ingredients, right? Copper wire, lumber, concrete, glass, steel, petroleum products. All of these commodities assembled in the form of a house sitting on a piece of land. That's the greatest investment ever, the most historically proven asset class in the entire world and entire history of the world. 20 years ago, all of the products that consumers bought were decided upon by stuffy executives in.
All right, everybody, good morning to all. We had a request, a frequent repeated request from one of our followers that I wear the headset. And we are listening. So I'm going to do that today for a portion of our talk. But we want to really get into analyzing a real estate deal, analyzing whether or not you should buy a property, to buy or not to buy. That is the question. So please post your questions below. I know you guys always have a lot of great comments and questions. We've got someone coming in now, or some of them coming in now. Ultimate Bargains, Theory X managers are history. What is a Theory X manager? I'd like to know more about that. I'm curious. Was that, that's not a Peter Drucker thing, and Peter Drucker was definitely the greatest management consultant ever. What a brilliant guy. I just love reading his work, and his stuff is great. I was a pretty decent student of Peter Drucker. Okay, so we are going to get into analyzing a real estate deal, and for this, I want to show you a video. Now, this is a video that I published a while back, and I am going to stop it and start it and chime in with my snarky comments because I know you love those snarky comments. So let's go ahead and dive into that right now. Keep posting your questions. When I interrupt the video, I'll try and grab a few questions each time and go ahead and put your questions and comments down below. And don't forget to like and subscribe. If you are watching on our YouTube feed, be sure you're subscribed to the channel so you won't miss any of the upcoming content, and hit the notification bell as well. All right, let's go ahead and dive into this. Let's start this, and then I will be stopping with frequent comments, sarcasm, clarification, and to take your questions. So post your questions, and we will get to those questions, comments, even comments, skepticism, all of that stuff.
Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before, and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness.
Good questions coming in here, folks.
Possible. Jason is a genuine self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
This is Jason Hartman, jasonhartman.com. Thanks so
Okay,
much
I'm going
for
to
joining.
fast forward past this. This is the part of our website where you can browse markets and properties. And we're going to go in here and we're going to pick a property and we're going to analyze every single number on the pro forma. So let's do it.
6 of our featured markets. We always have kind of our featured markets that are usually the busiest for us and where most of our investors are purchasing, shown here. So here we have Atlanta, Memphis, Indianapolis, Houston, Birmingham, and Kansas City, the Missouri side of Kansas City. And then here we have a map of the entire country. And you can see that there are more markets where we have properties if you just hover over a state. So if you hover over Florida, you can see we've got 3 areas and 6 properties there: Georgia, South Carolina, Alabama, Mississippi, Arkansas, Tennessee, Missouri, Illinois, Indiana, Ohio, Texas, and Colorado. So you can see we've got more than just the featured markets there. But for purposes of today, since Memphis is a city with such fantastic cash flow, I just wanted to show you a property in there. So we'd click on Memphis, and sometimes our markets have a nice featured video here that gives you a little area orientation, although you've probably already heard that on my podcast or from one of our investment counselors or local market specialists, but for some of them it's there. And then we click Browse Memphis Properties. And here we see a whole list of properties, and note that this is page 4 of 7. Page 4 of 7. I'm going to turn on my highlighter here so it's a little more apparent. You can follow my mouse around. And here we have several properties. You see they're organized by price in this example. And here's the return on investment that is projected for each property and the status. The market is moving very quickly nowadays, so many of these properties are sold, but some of them are available, some are under contract, and they're just all different statuses. So I picked a property. Why is this offering to translate my page? Because that's because I was just traveling probably, and Google knew that. So here I already picked a property for us for this example. And let me just go to that specific property and let's take a look at that pro forma. And here it is. So this property is in Memphis and it is looking good. I'll make the screen a little bit larger for you. So as we're going through the pro forma here, we see that this property is a nice looking home and it's 1,400 square feet. Memphis home built in 1980, and some little information there. Initial market value is $82,000 and purchase price is $82,000. Now, one of the tricks I've seen a lot of promoters and a lot of groups play when they're looking at these pro formas, sometimes they use the same software we do, mostly they don't. One of the big things I want to caution investors for, and one of the first things I did years ago when I really got into nationwide investing, is I standardized the data. I'm a huge believer in data standardization, because then once you learn how to read this one-page pro forma that we're going to learn right now, you don't have to be a detective. You can find all of the basic information you need about at least the numbers side, the quantitative side of the property right here on this performa. So data standardization is absolutely critical. Now, one of the things I see a lot of promoters and groups doing that I think is really wrong is they will set the initial market value different from the purchase price, and that will make your return look astronomical. And even though some of our properties, I believe, are actually below market properties, I will not allow any of our local market specialists to represent the properties that way because I think it sets false expectations. And besides, in our business, we're really in the business of cash flow investing, buying properties that make sense from day one, from the day you buy them. So it's not about appreciation for us. If appreciation happens, hey, that's great. It's icing on the cake. I'll take it. But I'm certainly not depending on it as a good conservative investor. So speaking of which, before I even finish going through this top part, let me scroll down here and let's look at assumptions. Assumptions is critically important because it drives a lot of the numbers on here. And you'll see we have the appreciation rate, the vacancy rate, the management fees, because all of these properties are including property manager fees. So you never get the midnight call, the metaphorical midnight call that, by the way, on my self-managed properties has never happened to me in over 20 years. I just must mention that. But you'll never get that because your property manager is managing the property for you and the tenants don't even know who you are. And then maintenance percentage showing that we've got maintenance. So here are the assumptions that this performa is using to drive some of its stats. And we'll get back to that in a moment, but I just want to mention it now. We'll get back to why the assumptions are the way they are in a moment. So we've got the down payment. Now, here is the mortgage info section you see over here. Whoops. You see the mortgage info section. And this is, of course, subject to qualifying for the loan. But in this performa, we're assuming 20% down, 80% loan to value. So that would mean that you would need about $16,400 down. Then you have some closing costs. And I want you to note that closing costs will vary depending on your lender and the type of loan program you choose. So those vary, and those also have some impact on your interest rate, where it's really a game where the borrower can make the decision between, do they want a lower rate or a higher rate, and that will affect the closing costs. Talk to your lender for details on that. And of course, we have lender referrals available for you as well. Now, if the property wasn't rent ready, if it wasn't a turnkey property, you see where it says other closing cost and fix-up cost. Here it says 0 because this is a turnkey property, so it's ready to rent the day you close on it. And some of our properties are even pre-rented, where there's a tenant already in them. But some are not, and so that varies. But this one, no fix-up cost. Occasionally, not often, but we have properties where the buyer does their rehab on the property, the investor does that after they close on the property. So in that case, it might show $10,000 in rehab or fix-up costs here. Okay, so total initial cash invested here is projected at just over $20,000, and that's based on qualifying for this loan. And the cost per square foot on this property, I always want you to look at cost per square foot because that's a really neat thing. You know that I talk a lot about something I call regression to replacement costs. In my risk evaluator, I talk about buying at or below the cost of construction and why that's important, and basically getting free land in the deal so that you can minimize your risk. I don't like high land value markets at all. Those markets have proven historically to be very risky. And if at all possible, I want to buy below the cost of actual construction. We can see here that this property is only $58 per square foot. And I would venture to guess that you cannot build the property for that price, for $58 per square foot. It will probably cost you at a minimum, and this of course varies by area and construction quality and the builder and so forth, but at a minimum, you're probably looking at about $70 per square foot plus the cost of the land. So I like cheap or free land, and I like all of my costs to be in the improvement or the house sitting on the property, because that dramatically lowers my risk. For more on that, listen to the podcasts that I've done at jasonhartman.com or iTunes or Stitcher Radio, where I talk about how to minimize risk when investing. It took me 19 years to discover that, and it is truly new thinking in terms of investing, and I think it's very, very helpful. So monthly rent per square foot, it's kind of interesting. This one's projected at $16. However, we don't pay a ton of attention to that one. As we look down here, we can see that the projected rent on the property is $9.
I'm not sure why I just said $16. That's 69 cents per square foot. I didn't notice that in this video before. But anyway, okay, let's take a look at this pro forma. So first off, the importance of data standardization. Folks, I see so many investors make so many mistakes when they do not standardize things. You must. It doesn't have to be this format. By the way, this is a software that one of our clients developed, and I actually bought the company from him a few years back. It's called Property Tracker. So go to propertytracker.com. You can get a 30-day free trial for this and then cancel at any time. Propertytracker.com. It's just a fantastic little software, and I like it so much I bought the company. So, but I started using this back in 2004, and just a fantastic product. So you must standardize your data. That is the first and biggest lesson from today. Okay, standardize data so that you don't have to be a detective every time you look at another deal, every time you look at another property. I got to tell you, I've been car shopping on and off for a few months. The lease on my BMW is up, and I don't think I'm ever going back to BMW. I think they're just kind of expensive and overrated, although I've owned many of them over the years. But the lease is up, and every person in the world, or at least in the US, will share this idea that shopping for a car is such a hassle. It is such a hassle. And the same is true of shopping for properties if you don't standardize your data. And a lot of promoters out there, they don't want you to standardize your data. Why? Because standardizing your data makes you smarter. It makes you a better investor. It makes it so you can take the detective work out of it. You look at this one-page pro forma, this one-year performance projection, and it'll show you almost everything you need to know from a quantitative perspective. Now, there are different qualitative things that, of course, matter as well. And, we have a team of people that are ready to help you with that. And my podcast and hopefully these live streams and the YouTube channel, all of that stuff will help you with that. But today we're looking at the quantitative aspects. And as we look at that, we just really want to standardize our data. So the top part of this pro forma here, not where the highlighted mouse is on the video, just my other mouse here, my active mouse, shows you details about the property, kind of the basics in this top part. And as you can see, this is not a property you can buy today. Sorry, this deal's gone 4 years ago, okay? But what's interesting about it is many people are looking to time the market. That's always a disease of human thinking. Market timing. It's the market timing disease. And why is that a disease? Well, it's a disease because market timers rarely, if ever, win over time. Well, I can't say if ever, because occasionally they do win. Occasionally you'll just guess it right, and you'll ride it, and you'll cash out at the right time, and you'll buy at the right time, and good for you, congratulations. I mean, it's rare that happens. My little clapping machine just goes on too long. Anyway, it's rare that happens, that timing working. The best thing to do is just to buy properties that make sense the day you buy them and hang on to them. And how do you know if it makes sense? Well, you follow my 10 commandments of successful investing strategy. So in looking at this, timing the market does not work. in any real way. It has never worked in any consistent way for anybody. But I do want to point out that right now you can get a loan at a lower rate than you could get when people bought this house, right? So we sold this house a few years back, and the interest rates were higher, obviously, right? So when you look at the real cost of owning the property, the cost of owning some properties in some markets, depending on the type of financing you can get, has actually gone down. Why do you think the market is booming? Why do you think the market is just going absolutely crazy right now? Because of that actual, that reality, right? The market is booming because the money is so cheap. You're literally in a situation where you are getting paid to borrow money right now, paid to borrow money. Okay, so let's go through a couple of your questions and comments. Hey, Ultimate Bargains. Good morning, Gold Color. And great investors. Yes, good morning to you too. Before your time. Hey, thanks. I appreciate it. So what is this? $20,000 is 5 properties? I don't get it. Typically in our network, if you go to jasonhartman.com and you look at the properties page, you're looking at about $25,000 per property. So that's sort of the typical thing. If you buy a more expensive property, it's obviously more. And obviously, it's always subject to qualifying for the financing. Theory X managers, yeah, I asked you about that. I hope you're going to answer that question. Good morning, Sapan. How are you? Okay. What's your main strategy right now? Well, my main strategy, interestingly, has not changed in 16 years. It's been the same. I know. I'm a little boring. Main strategy is the same strategy it was 16 years ago. Buy good properties that make sense the day you buy them in good quality suburban markets. And guess what? You're going to make a lot of money. And that strategy has not changed. It's the same strategy I was recommending in 2004. Theory X management means employees must be in the office and watched all the time or else they will goof off. Ah, thank you for that. Thank you for that. Where does that Theory X thing come from? Is that a Peter Drucker or Tom Peters type of concept? I'm kind of wondering. Okay, just finished. For the most part, which everyone needs to form a trust and LLCs. Yes, it is a good idea to do that stuff and to form entities, but it's not required. And the only thing I want to say about it is I don't want that to become the thing that people get all mired in and they miss out on investing. There's an old saying, putting the cart before the horse, right? And you don't want to put the cart before the horse. But yeah, certainly having entities and all that stuff, great idea. By the way, we have a brand new webinar on that, and it's totally free. It's about an hour and a half long. It's really in-depth and detailed. You can find that and by the way, it's running this afternoon and evening, running it 2 times today. jasonhartman.com/protect. jasonhartman.com/protect. Check out our webinar on estate planning and asset protection. I think that'll be very valuable for you. We've had a couple hundred people go through that, and they're just raving about it. And this is the 2.0 version. The lawyer that we're working with on this, he took a whole bunch of the questions and comments from the first webinar we did with him, 1.0, and he made 2.0. 2.0. So that's at jasonhartman.com/protect, and you can watch that today. So check it out. And good stuff. Okay, what are the best locations or markets to purchase a home? The local rate, so you can rent it at a later time. Well, I'd say all of those are at jasonhartman.com/properties. Don, we've got a bunch of different markets that we recommend at any given time. Now, I do have to say, in the interest of full disclosure, that we are not in every market we would like to be in. Why is that? So when you go to our website, you click on the properties page, you will not find every market that is a good market. Reason being, we haven't found a team that we want to work with there where we want to recommend their properties. So because of that, as I've always said, I'd rather have an A team with a B market than the other way around, than a B team with an A market, because the team is really more important than the market. Okay, so that's one thing to be very conscious of. Muthaya, welcome. Just saying hello to Sapon, and welcome. Hi, Metal Bum. Hey, Carrie. Carrie's one of our team members. Good morning to you too. Okay, what else we got here? David. Good morning, David. Okay, by the way, this is Ultimate Bargains. It says, by the way, lenders quote minimum DSCR. What is that? I thought I knew every acronym. I don't. Debt service coverage ratio. I'm guessing it's the debt service coverage ratio. Yes, I've not heard that referred to very much, but we're going to go into the debt coverage ratio. That's coming up here. Okay, maximum LTV or loan to value ratio. Those four ratios determine the cap rate and the cash on cash return, even before you know the income and expenses. Okay, good stuff. Good morning, Paul. And by the way, please put your city. I forgot to ask that. When you make a comment or ask a question, it's great if we have your location. Derek from Los Angeles, good morning. Derek, it looks like you're a drummer, huh? You know, the greatest drummer that ever lived passed away only recently, and that was Neil Peart, the drummer for Rush, the most talented band that ever walked the face of the earth. So, good stuff. Anyway, Matthew says, hi, Jason. Are there other single-family home rental markets that are making sense now with lower rates than the traditional linear markets with whom many are already familiar? Well, not cyclical markets. The cyclical markets don't make sense, Matthew. And by the way, that's a great question, because the rates being so low, they let you cheat a little bit, right? They let you, they give you more room to play, right? That opportunity from our rich Uncle Ben, or not Ben, I was thinking of Uncle Ben's rice, or is that Quaker oatmeal, or I don't know, whatever the reference was, and Uncle Ben Bernanke. No, we have Uncle Jerome Powell, our rich uncle now. So he has really done us just an incredible favor with these low interest rates. So, you can afford to be more lax on that typical rent to value ratio I've always recommended of close to 1% of the value each month. In other words, $100,000 property, just for round numbers sake, property rents for $1,000 per month. That's 1% of the value per month. And you really don't have to be so concerned about that right now as you used to, because you have more latitude with these incredibly low interest rates to go outside of that parameter a bit. And so you can afford to venture into more hybrid markets. And by the way, we've got one of those at least, and that's Atlanta, Georgia. Atlanta, I would classify for several years now as a hybrid market. Three types of markets in the world: linear, cyclical, and hybrid. Talked about that a lot on the podcast and the YouTube channel. We always recommend the good linear markets. They're the good, solid cash flow markets where you're very unlikely to make a mistake. But now you can get a little more hybrid-ish, and you can afford to do that. Okay, Devin asks, Jason, do you think it's a good time to consider increasing cash reserves with potential big opportunities to acquire single-family homes on the horizon? You know, Devin, I think I kind of addressed that or alluded to that a moment ago when I talked about the timing the market philosophy that just doesn't work. Look, if everybody's looking for a market crash, I believe, first of all, you're going to see that in the cyclical markets. I don't think you're going to see it in the linear markets to any real degree. I mean, yeah, it may happen, but it's going to be relatively minor and unpronounced if it does happen. There's a lot of uncertainty in the economy right now, for sure. No one would deny that. But apply the Warren Buffett strategy to income property. Buy good properties that make sense the day you buy them and hold on to them. That is far and away the safest bet. Thanks for the question. Stephen from Vancouver, good morning, and talk about a cyclical market that's a massive bubble and that would be Vancouver. Beautiful city, great city, but wow, what a market. That's the poster child for cyclical bubble markets. It really is. Good morning, Stephanie from Los Angeles. All right, Derek in Los Angeles. Hey, thanks for telling us. After seeing a property listed and running the numbers through the analyzer, what should the approximate elapsed time to commit to buying the property with the reality of limited inventory? Oh, Derek, that's a tough question. You know, every property is an individual case-by-case basis, and they are going fast, lickety-split. Multiple offers on many properties, bidding wars on many properties in many parts of the country. So the answer is, I don't know. It's individual case-by-case situation for everything, Okay, let's go on. Let's look at more of the performance here. Thank you for your great questions and comments. Keep them coming. I will have a break here in a moment, and I'll get to more of those.
75 per month. Now, the annualized numbers are here, but in commercial real estate, most investors talk about annualized numbers. And for some reason in residential, they mostly talk about monthly numbers. It all boils down to the same thing at the end of the day. And you can see the vacancy losses here. That's driven by the vacancy rate down here that we require our local market specialists to put in at least 1 month per year, or about 8%. So you see how we have vacancy losses. Then we have operating income. Moving down the sheet, we have property taxes. And again, these are estimates by the local market specialists. We make them put in all the data so that they're representing it. No one knows the market better than they do. But again, things can vary a little bit. So, you know, we always recommend that investors ask a lot of questions, check things out. We teach a whole program on like due diligence and all of that stuff. That's not what this one is about. We're talking about how to read the performance. So I'm going to try and stick to that and focus on it. Insurance is performed at $37 per month. Management fees. Now, management fee is driven by the assumption here, which in this case is 8%. So 8% of your rent every month of this $975 totals $71. See how that works? And then leasing and advertising fees and association fees, those are both zero in this case with this property. Maintenance is driven by the assumption down here of 3% per month. So 3% of your rent every month adds up to about $29 in maintenance fee. Operating expenses total, right there, $247. Going down, we've got our net operating income, $649 per month. We've got our mortgage payment. How is that calculated? Right here, it shows the type of loan that we're talking about on this property. And then we've got our cash flow here is positive cash flow projected at $296 per month, or almost $3,600 per year. Pretty darn good. Principal reduction. See, our tenant is paying off our mortgage for us every month. That's a beautiful thing. $80 per month paid by our lovely tenants, or almost $1,000 annually. And our first year appreciation here of 410 is driven by the real estate appreciation rate assumption at 6% annually. Now, if you look at appreciation rates historically, you'll see that over many, many years, 6% is about the commonly considered average. Of course, you can slice and dice this about 1,000 ways because it depends on the market. That's a national number. It depends on the exact period because it's an average. So if you average just the last few years, well, if you start at the financial crisis, that would have been devastating because real estate depreciated in some places a lot more than others. And then it started appreciating about 3 years ago or so at the time of this recording. And it's had some fantastic appreciation since then. And then, it depends if you look at new homes or resale homes and all kinds of different things. But generally speaking, the accepted number is about 6% annually. And look, keep in mind, we don't invest for appreciation anyway. We invest for cash flow. We want yield. It is all driven by yield in our mind, because being the conservative investor, you invest for cash flow. If you're a gambler, you invest for appreciation. Okay, so there we've got some additional numbers. Now, none of these, we don't pay too much attention to gross equity income. We're not going to address tax savings at all in this pro forma discussion today because that's a fairly complicated issue. We have addressed it on many of the podcasts on the Creating Wealth Show at jasonhartman.com. So let's go over here. We talked about the loan assumptions. One thing I do want you to know is that interest rates for investment properties are a little bit higher than they are for owner-occupied properties. And we always try to get our local market specialists to be a little bit conservative on this number. In other words, estimate a little higher than it's probably going to be. But the interest rate varies based on the closing costs you pay and the type of loan you choose, and your credit score, your ability to qualify, etc. But just know that for investment properties, the rate is a little bit higher. Financial indicators. This is a very important section. I really want you to pay attention to this particular section quite a bit. So the first one is debt coverage ratio. With the debt coverage ratio, that's the number that had a lot of investors paid attention to it. The financial crisis, or at least the mortgage meltdown crisis, may have never actually happened. But investors weren't really investors, they were gamblers, and they were doing a lot of silly things. They weren't paying attention to debt, they weren't paying attention to income on the property, they were just investing based on the greater fool theory, and the greater fool theory goes like this. No matter what I pay for the property, some greater fool will come along and pay even more. That is not investing, my friends. That is gambling. That is speculating, and it's stupid. Okay, so don't do that. Let's invest. Let's invest conservatively. Let's invest for cash flow. Cash flow, pretty darn reliable. Appreciation, very unreliable, very, very fickle. So here you see the debt coverage ratio on this property is excellent. It's 1.84. Meaning you have positive cash flow here of about $300 per month almost, or almost $3,600 per year based on this pro forma. And so that debt coverage ratio is excellent. You're very unlikely to get into any trouble with this property. You would have to have a lot of vacancy problems, collection problems, repair problems, be a bad landlord, have a bad property manager. You'd have to have a whole host of problems to mess this one up. So this property looks pretty darn good. Gross rent multiplier, both monthly and annual, we don't pay too much attention to that. Not really that meaningful. It is kind of a nice rule of thumb, but if you want to have a rule of thumb number, the one I would rather have you use is the RV ratio that I talk about a lot, or the rent to value ratio. So here, I always say that a good rent to value ratio is about 1% per month. So here we've got an $82,000 property, and the rent is projected at $975 per month. That's more than 1% per month, right? Because if it was 1% per month, an $82,000 property would rent for only $820 per month. And here, you're in pretty darn good shape. So I like this property quite well. 1% is ideal. Sometimes you even do a little better. Rent to value ratios are getting worse as properties appreciate, because remember, prices go up a lot faster than rents go up, historically speaking. So great property here. I really like this one. Now, capitalization rate, or cap rate as it's known, is commonly used with commercial real estate investors. I think it is a relatively flawed metric because it doesn't take into account a couple very important factors. Number one, it doesn't take into account appreciation. And number two, it doesn't take into account leverage. Remember what that acronym, real estate is ideal? Well, the L in the word ideal stands for leverage, and the A stands for appreciation. Cap rate completely leaves those two very important metrics out. Now, the reason you might be asking, why is it such a big deal in commercial real estate? Why does everybody say, it's an 8 cap or it's a 6 cap or a 4 cap or whatever the cap rate is when they're talking about commercial real estate? Well, the reason I believe they say that is, number one, real estate in the commercial category does not appreciate as well as residential real estate. Why is that? Well, because it's based mostly on income. And I've leased many commercial properties over the years for my companies, and the typical commercial lease will include rent increases based on the Consumer Price Index, the CPI. And as you know, I believe, and many other people agree with me on this, that the CPI is understated intentionally by the government. Two major reasons for that. Number one, all the government spending and the government entitlement programs and the government employee wages and salaries are indexed typically to the CPI, the Consumer Price Index. So if that is understated, then the government can save some money. Number two, main reason, there are others, but big reason, is that they want to keep the populace happy. They want to keep the electorate happy. And if we believe inflation is really high, we're not likely to vote the incumbents back into office and let them keep their jobs. So they want to fool us into believing inflation is lower than it is. And they do this in many ways that I've talked about: weighting, substitution, hedonic indexing, etc. Lots of information on that on the podcast and at my live seminars. Okay, so the cap rate on this property is 9.5%. That is an excellent cap rate. On a commercial property, you typically wouldn't see that high a cap rate. Occasionally you will.
And you won't see that on a residential property anymore either. But so what? Remember, the cap rate or the crap rate, come on, call it the crap rate with me. It's really, I sort of don't understand why that metric became so popular in the commercial real estate world. Of course, the commercial real estate people will tell you that, well, it allows you to compare one property to another regardless of financing, right? Why should the financing influence the deal or the evaluation of the deal? The financing, the way they look at it is the financing is the financing, right? But I just want to know what the property is like. And again, they're just totally missing out on financing and appreciation, which are huge factors in the deal. So that's why we can jokingly call it the crap rate. I mean, it's not, it's not the worst thing ever, but I'd rather go with cash on cash, the next metric, over the crap rate. Okay. So remember, you're going to leave today and you're going to call it the crap rate, not the cap rate. Okay. All right. So Metal Bum asks, what do you think of tertiary markets near big Western cities, relatively cheaper, but within an hour drive of downtowns like Palmdale, San Bernardino, Riverside? Well, I think they would be fine, Metal Bum, if you could get good enough prices, but they're just too expensive. I mean, look, I haven't honestly looked in Palmdale lately, but I have looked at San Bernardino, Riverside. Remember, I grew up in LA. I used to live in Orange County as an adult, and the inland empire of that is San Bernardino, Riverside. And those markets, we tried to get them to make sense back during the Great Recession. We tried to do deals there, but we just couldn't. The deals just weren't good enough. The prices were still out of whack. Unless you're just an appreciation investor, then fine, you can rationalize it that way. But we could not get the deals to make sense there. So, again, I wouldn't do it. So that's just my thought. Okay, for new construction, are landscaping and driveways included? Good question. That does vary, by the way. Driveways should always be included. In most places, I think you're going to find that is a code requirement. And in most places, they do front yard landscaping at least. On any property that you're looking at through our network, I don't want to say any property because there might be an exception, but on any property I know of in our network, it's going to have landscaping completely. Okay. Now you can always upgrade landscaping and so forth, but landscaping is always going to be included. But remember, real estate is a fragmented business. Talk to our team members, talk to the seller, the local market specialist, and they will, confirm that for you. But I can't think of a case on a property through our network where landscaping wasn't included. I don't want to say it would never happen though. Okay, so generally yes, almost 99% of the time. Okay, how about Southeast Florida, Fort Lauderdale or Palm Beach? Well, I live in Palm Beach. It's way too expensive here, folks. You can't touch property in this area that would make sense in a zillion years. Fort Lauderdale, same thing, way too expensive. So again, those are cyclical markets. Like Miami, same deal, just too darn expensive. Now, if you go into some of the less trophy areas in this area, they can work, but usually the east coast of Florida, pretty hard to make it work. Now, the exception would be Jacksonville, and we've occasionally got some short-term rental properties in St. Augustine. We don't love short-term rentals, but there are a few that make sense, and that's one of them. And then also on the east or the west coast of Florida, I'm a West Coast guy most of my life, so I always get the directions mixed up, and I want to say on the West Coast, that's where you think the ocean is. There is the Gulf is on the West Coast here, obviously. So you can do some stuff there. You could do Ocala. We've got a lot of Florida properties, a lot of Florida markets that do make sense, but the East Coast of Florida is pretty much, that's the expensive area, especially the Southeast or Central East, and it's just not going to work. Good morning, Ralph from Phoenix. Okay, Long Beach. You're liking raw land. Are you kidding me? Raw land doesn't give you any income. Why do you like raw land? Remember my definition. To qualify as an investment, what must a deal of any sort have? It's got to have one thing for sure. It's got to have income. Yes. Precious metals are not an investment. I see that your handle is gold color, so I'm guessing you're a precious metals person, okay? Gold, silver, platinum, palladium, any other metal, cryptocurrency, Bitcoin, all the rest, raw land, no income. If it does not have income, it is only a speculation or a gamble. It is not an investment. It must have income to qualify as an investment. So that's why I like income property specifically. That's the name. Income is the first word in income property. That's why I love that. And it gives you, and listen, by the way, I want to say something here. In deference to your comment, okay, look at, people have definitely made money speculating. You get raw land in the path of progress where development is coming, you can make money. You get, gold bars and the price of gold goes up, you make money. You buy a property in a cyclical market that does not make sense, that doesn't produce income, you can make money. You buy Bitcoin when it's cheap and price goes up, you make money. I'm not saying you can't make money. I'm just saying that you can't reliably make money on speculative things like raw land, precious metals, cryptocurrencies, cyclical markets, etc. Okay? Those are risk-oriented investments. If you are wealthy and you want to take 10, 15% of your net worth and gamble with it a little bit, you can afford to lose it. Okay, so fine, you might hit a home run, might be great. Same with startups, private placement memorandums, things like that. Speculative investments, non-dividend paying stocks, speculative investments, because it's only one-dimensional. The whole game is buy low, sell high. That's the entire strategy, right? Buy low, sell high. But with income property, you're really getting all those other multi-dimensional characteristics. And yes, okay, you're just talking to the gold color. We got two precious metals people chatting away here on the thread. That's great. Okay. All your cash in 20,000. So your debt coverage ratio is 1.83, rate 5% term. Okay, I don't have time to follow the math here, but I'm not sure if you're verifying what's on my performa or if you're differing with it. I don't know because I don't have time to go through all that math here with a million questions piling up. Doesn't seem like maintenance. Doesn't it seem like the maintenance amount is a little low? Where's the capex? Good question, Dan. I'm glad you asked that question. Well, it depends on the age of the property, and you know what? You're actually right. This property, and remember, these proformas, these properties are uploaded by our local market specialists, and we're constantly getting on their case about the percentages and so forth. So for a brand new property, we would typically proforma a 2% maintenance. And, ideally, you're not going to spend that money and you can save it for CapEx. Now, your CapEx on a renovated property or a new property is hopefully at least 8 years out. And that first CapEx, by the way, when he says CapEx, that means a capital improvement. And that is different from ongoing minor maintenance and repair expenses, okay? But capital improvements like a new roof, a new water heater, new appliances, things like this, new flooring, that CapEx shouldn't be more than every 8 to 15 years, okay? But it also depends on the property. One example of that is, whenever you're redoing flooring on your properties, if you bought a property that has carpet, I say redo that carpet. When you've got to replace carpet, don't replace it. Go to hard surface floors like the vinyl plank floors, because even though it costs a little more to do that CapEx, it's going to be like free forever practically after that. You're just not likely to ever have to do anything to those floors. I mean, they're just going to be there unless they just tear them, which, that happens is pretty rare. But you want to make your properties bulletproof. The other suggestion I make is when you repaint a property, use eggshell finish paint. Now, I'm not talking about the eggshell color. I'm talking about the finish. Okay, low sheen or eggshell. That's sort of like more like enamel type paint. It's not enamel, but it's the next step toward it. And it's very durable, extremely durable. That paint will last you a long, long time. And also, don't forget to charge your tenants for this stuff. That's what security deposits are for, folks. Don't be afraid to expect them to pay money out of their security deposits for damaging the property, okay? So minimize CapEx that way, but that's a very good question. Paul says, bless you. Thank you. Bless you too, Paul. Okay, Dan, where would you take the tenant turnover from? It seems like the average cost is about $15,000 to $2,500 per turn. Well, let me tell you, Dan, that is a good point. And some of that has got to be CapEx because your tenants should be paying for the turn. The only thing you can't charge them for is normal wear and tear. But if you have hard surface floors in your properties and eggshell or low sheen paint, your wear and tear should be like minimal, okay? There's just not going to be much wear and tear. And if you self-manage your properties, I find that you're going to have much better luck getting your tenants to pay out of that security deposit. Whereas your property managers are going to be less likely to enforce the rules because a property manager is in the unenviable position of serving two masters. Yes, you as the owner, as the investor, you're supposed to be the client, but in reality, your property manager is also catering to the tenant. And I don't like that arrangement. That's why we really recommend self-management. We really recommend that you join our Empowered Investor Inner Circle for a lot more on that. Check out the podcast episodes I've done on that, the YouTube videos, etc. Okay? I built an Excel model that does this. Okay, great. Good for you. But it's going to be harder and more clunky to use than this. So, but hey, more power to you, Kevin. Okay, so, and I know, Kevin, you got some other comments and questions in here, so we'll get to those in a moment. Where are we? Hate it when you get off the question here. Okay. Hang on here, folks. Here, okay. And Denver Gray. Denver, is that your name? That's a very cool name, I must say. What's up? Kevin says, get a Lexus LC 500 used. Well, definitely getting a pre-owned car is the best deal. You won't have to take the depreciation. And you know what? That LC 500 is a good looking car. I agree. I like that car. It's probably Lexus's only good looking car. You know the thing I don't like about it, though, is I just don't like that grill in the front. It looks like a catfish. I'm just not a fan of it. But the rest of that car is beautiful. That is a good looking car. They just got to change the grill. Why did they do that? Okay, let's get back to the video here because we got a lot to get through and a lot more to talk about.
9.5%, excellent cap rate, even though I don't really like the cap rate metric and I don't really pay a whole bunch of attention to it. It's okay, but it's limiting. One that I actually like better is this next one, cash on cash return.
Much better.
Cash on cash return is better because what it says is that as long as you maintain the same income and expense ratio on the property could go to 0 in value. It could be cut in half in value. This $82,000 property could be worth only $41,000, just half that amount a few years from now. But as long as you receive $975 per month, you maintain the same expense ratio, you are going to earn 18% annually on your property. That is phenomenal. Now, as I always say, even if it only goes half as well as projected, in this case, you're still going to get 9%. That's pretty darn good. The total return on investment, this is the metric that considers everything, and it's kind of debatable that it doesn't even consider inflation-induced debt destruction, which is another subject I've talked about in detail on the podcast. But this overall or total return on investment includes everything on the pro forma, and here you can see it's projected at 46% annually. Now you may be thinking, wow, really? This is too good to be true. Well, the reason that is possible and the reason that income property, especially residential income property, has created millions of wealthy people and made lots and lots of money for decades and decades historically for people is that it is a multi-dimensional asset class. And because it's a multi-dimensional asset class, unlike gold and silver that's just one-dimensional, you buy it and hope it appreciates in value, or stocks, most of which are one-dimensional, buy low, sell high. Dividend-paying stocks, two-dimensional, buy low, sell high, but also get some dividends in between. Income property is multi-dimensional in all of those ideal ways, okay? Income, depreciation, as a tax benefit, I mean depreciation, assuming you qualify for it, appreciation, equity, and leverage. So all of these great benefits are offered in a multi-dimensional asset class. That's why the returns can be 46% annually. They can be 20% annually, 25% annually. And even if it only goes half as well in this example, 23% annually, which I think would make most investors pretty darn happy. Anyway, a lot more information at jasonhartman.com and on the podcast available at jasonhartman.com or on iTunes or Stitcher Radio. So happy investing to you, and thanks for listening.
All right, there we go. So let's fix that. So I hope that was helpful. Now, questions on the pro forma. Any questions on the pro forma, folks? I know we've got more coming in. Let's get to these. Okay. Boy, we've got a whole car discussion going on our thread, huh? Oh, I tell you. Okay, let's see here. so, okay, ultimate bargains, cap rate, and CCR. What is CCR? Debt coverage ratio. I know that one. DCR, rate, term, LTV ratios, quoted by lenders. Therefore, lenders determine the cap and the CCR. Not comparable sales. Well, on residential property, though, they're doing comparable sales in the appraisal, because these appraisals won't go by income approach, because these are 1 to 4 units. So they will consider rental income, but they'll discount at 25%, as you know. But they're not doing straight income approach like they are on commercial property. Okay, so I hope that makes sense. Lexus too expensive to get repairs on. Acura turbo. Well, folks, yeah, I get it. And listen, cars and boats and toys, and I've owned a bunch of them, and they're always a loss. You're never going to do well on that. And look at what Kevin says here. That engine will run 400,000 miles. Yeah, you're probably right. It will. They'll run a long time, and then you got 167,000 on your Nissan. But isn't the point to get a new car every couple of years and have nice things? That's why we're talking about making money, right? So, a rational amount of frugality, completely agree. Too much frugality, what's the point, right? You gotta spend some money and enjoy life. Okay, so I like what you're saying here. Thank you, Kevin. Yeah, good. Definitely good decision, Kevin, on the linear markets. Okay, have around $450,000 liquid assets ready to go. Well, Kevin, reach out to us and we will be happy to help you with that. By the way, I noticed that a couple of you are looking at the little banner we've got scrolling across the screen on the bottom. Go to pandemicinvesting.com and make sure you get our free mini book there. You'll really like this. This is just a free thing, of course, no strings attached. And pandemicinvesting.com. Get that free mini book. It's and another one of you just got it. I'm looking at my email notifications here. So take advantage of that. That's a really good little primer on investing during times of pandemic. And right now it's really pandemic plus civil unrest, obviously, and absolute craziness. What's going on in the world right now? I do want the pandemic to play out. It's probably... Yeah, Kevin, I don't know, man. I think that market timing, I mean, look, let's just think about this for a second. Let's just roll the clock back, and let's say that we are now back in March, okay? So let's right now it's September 20th. Let's roll the clock back to March, okay? Everybody in March and everybody in April thought the world was coming to an end, okay? They thought, oh my God, the housing market is going to crash. This crash is imminent. And look at what's happened. The complete opposite has happened. The market is booming. Prices have risen. The average new construction home is $16,000 more expensive than it was just a couple of months ago in only one aspect, just from lumber cost increases. Okay? So be really careful about this market timing stuff. This could be an incredibly costly thing for you. And I'm talking to anybody listening, okay? I'm not talking to you in particular, but just take a look at some of this stuff, okay? And I'll blow this up here on this slide, okay? So this is, I think I showed you this one last week. Home builder confidence was the highest it's been in 22 years, but guess what? A new study came out after this one and said home builder confidence is now the highest it's been in, are you ready for this? 35 years. And by the way, be sure you are on our mailing list. In the email, the email blast that I sent out yesterday, our weekly newsletter, that, by the way, I'm really getting into our weekly newsletter, and I'm starting to really enjoy creating that and writing for it and so forth. It cited this home builder confidence being the highest it's been now in 35 years, not 22 years. So the market has got a good runway ahead of it. Young adults living with their parents. I think I shared this one last week. Highest rate ever. Why is this important? Because this represents shadow demand for housing. These young people 18 to 29-year-old, they will move out and they will buy houses. They will rent houses. There's this huge shadow demand in the marketplace that isn't even hitting the market. And the market is already reflecting a massive housing shortage with bidding wars, with prices increasing. Now, listen, I really don't care if this happens the way I'm talking about it. I'm just giving you news. I'm not making a prediction. Say, for example, it goes the other way. Say the market slows down. Frankly, I find the market we're in right now very hard to operate. I don't like markets like this as a intermediary person, right? Where my company helps investors, figure out which markets to buy in and all that kind of stuff. This is a difficult market for us to operate in. What I like, I say that there are three types of markets. There's a buyer's market, a seller's market, and a broker's market. Okay, and the broker just represents a middleman of any sort, right? I'm not saying a broker, licensed broker, talking about that. I'm just saying any sort of intermediary position in the marketplace, right? This is a difficult market in which to operate. What I like is the sort of calm, measured market where, the sellers need to sell, the buyers need to buy, but neither of them are freaking out, okay? That is the easiest kind of market to operate in my opinion, and the most profitable market as well. But, you look at what's going on in the cities and people are just flooding out of these cities and they're buying in these suburban markets. That trend is not going to change after the pandemic plays out, whatever plays out means. I don't know if that means, okay, we've got a vaccine. I don't know if it means 7.5 billion people have actually, had the vaccine administered. I don't know what that means, but whatever it means plays out. There are some just major trends here which aren't reversing anytime soon, okay? I mean, just look at the charts. I don't need to tell you all of them. But look at travel, for example. Look at how travel has been just completely decimated. And for those who have money that haven't taken an income cut with what's going on in the world, look at all the extra money they have to spend that they're not spending on travel. Now, this is certainly bad for the tourism industry. It's terrible. But they've got all this extra money to spend on what has now become the center of the universe, their home, okay? Companies moving operations out of China, a lot of them moving back to the US. Trump has been a big, major proponent of this, and COVID only strengthened it. And, this is more American jobs, folks, and also inflationary pressures on consumer goods. That's also what that means, okay? So, and this is pretty good video. Remember this video from a few years ago? I'm not being political here, by the way. It just shows you about the concept of the trade moving or those jobs moving back to the U.S. Look at this.
You haven't done it in 30 years or 26 years.
Well, I've been a senator.
You haven't done it.
And I have been a secretary of state, and I have
Your husband signed NAFTA, which was one of the worst things that ever happened to the manufacturing industry.
That is your opinion.
You go to New England, you go to Ohio, Pennsylvania, you go anywhere you want, Secretary Clinton, and you will see devastation where manufacturing is down 30, 40, sometimes 50%. NAFTA is the worst trade deal maybe ever signed anywhere, but certainly ever signed in this country. And now you want to approve Trans-Pacific Partnership.
So there you go, folks. And you know what? Love or hate Trump, he is right. Okay? Get the partisan stuff out of the way. Even if you hate the guy, it doesn't mean he's wrong. Okay? He's been great for the economy. There is no question about that. That's like not debatable. Okay. So anyway, here we go. Here we go. The war will start. Oh, the comments that will come in on that. Here's another thing I want you to watch out for, though. Okay. So the mortgage securities, remember, the mortgage securities are the things backing the mortgage market, because when a mortgage is made, it turns into it's bundled up into a pool, and a security instrument is created out of this mortgage, right? And these mortgage securities tied to residential real estate still look pretty good, pretty strong. But there's a completely different story in the CMBS market, the commercial mortgage-backed securities. Okay, those are going to have just this massive domino effect through the economy as the defaults just, I was going to say trickle in. They're going to flood in like a tidal wave. Okay. So a lot of investors are going to be very much hurt by that. Okay. So looks like several of you are getting our pandemic investing mini book. That's at pandemicinvesting.com. Make sure you take advantage of that. Okay. So Kevin, yeah. Okay. Forget about the pandemic one. Yeah. Okay. So Dan says, this is why we send you Christmas gift cards, besides being a wonderful gesture. Yes, that's nice of you if you send that. I've never done that. I've never done any of that stuff for my tenants. I don't think you have to do that stuff. But, some people do it, and it's great. And, just self-managing your properties and, having a good relationship with the tenant and using, getting their help to help you improve the property while they occupy it. They just so much appreciate that. I can't even tell you. It's great. So, okay, ultimate bargains. I think you're answering other people's question in the thread. I do not have time to address the math here and the formulas, but I appreciate the analytical thinking. Okay, so I got to move on. Okay, should we spend much effort verifying the property tax and insurance or those figures? Oh, thank you for asking, Derek from Los Angeles. Great question. Yes, you should definitely verify these things. They are often misquoted by the property manager or the local market specialist or the seller. So do your own due diligence. That's commandment number 1 of my 10 commandments of successful investing. Be your own best advisor. Do your due diligence. Absolutely. Good question. Okay, Muthaya, or good comment. I would add that investors infinitely, yes, Muthaya is right, and Muthaya has a lot of experience. He's been a great customer of ours. So Muthaya, thank you for your business and for also for your contributions to the network like this one. I really appreciate that. Sellers and brokers skew the income higher. Yes, they do. You're absolutely right. Okay. I hate to say it, but Jason is right on his methodology. Kevin, why do you hate to say it? I'm glad that you said I'm right, but why do you hate to say that I'm right? Right states, right logic. Yes, I appreciate that. Thank you very much. Okay. Yeah, Paul says, yeah, well, I love Little Rock. You know that. And we've done well in our Mississippi markets as well. So that's great. It's just very limited inventory, as you know, Paul. But I know you're working with our people, and so they're answering those questions. But yes, I think those markets are fine. Very good. Very good. Okay, Kevin, biggest concern is having an affordable team in states. Fine. Good property managers. Yes, well, Kevin, that is why we created our Empowered Investor Inner Circle for just that reason, because we want to have you network with our clients and provide you with these resources in all those areas. Now, we can do that just as a typical customer. That's what our investment counselors will do for you. They'll help you with all of that good stuff. But taking it a step further, we have another offering called the Empowered Investor Inner Circle. Just reach out to us and we'll tell you all about that. Okay. Okay. Excellent analysis. I missed the headphone. I know, and I've got it right here, the headset. And I was going to put it on, but with the video on, I don't know. Do you like just that I'm wearing it because it looks dorky, or because the sound is so much better? Let me plug it in. All right. We should be on the headset. I hope we are. I don't know. I didn't see that. Okay, my mic is unmuted, right? Can you hear me, folks? Hang on, let me just test that. Okay, my mic is unmuted. Okay, yes, you can hear me. All right. See, this is what happens when you do this yourself and you don't have a big production team here. Thinking about buying raw land to build a house on. Oh, that's a lot of work, Kevin. Have you ever built a house before? You know, nobody ever says anything good about their contractor. Just keep that in mind. Rarely do people ever say anything good about their lawyer either. But contractors, I'd say that's an industry where you hear a lot of complaints. So build a house, you're going to be dealing with a whole bunch of them. Have you considered local risk? Yes, I have. And Peter, you know, I think the United States has a very special real estate market. Stuff outside it just doesn't work that well for so many reasons I've discussed on the podcast at length. It would take me 40 minutes to answer that question about why outside of the US just doesn't work very well, but there are many reasons. I love to travel. I've been to 87 countries. I haven't quite hit my 100 country mark yet, but you know, the US is a pretty special real estate market. So I have not found anything, and I've looked very, very much outside of the US for investments, and I just can't find anything that works that great. And I think Paul's answering that question. Looking for ICF. Okay, I lost my place there. Okay, yes, we got the sound working. So David, I think we got the sound working. Okay, yep. Headset was working before, then it stopped. Testing 1, 2, 3. No, you can hear me now. Okay, good. Okay. Headset, less echo. Yes, I understand that. Okay. Kevin, I voted for Trump. He voted for Trump. Well, congratulations. Okay. Raise rates for savers, balance the budget, stop bailouts, lower deficit spending, reduce government, which he has accomplished. You know, Trump has pretty much kept his campaign promises, folks. Again, a lot of people hate him. A lot of people love to hate the Donald, but that guy has kept his promises pretty darn well. Of course, you know, there's always unforeseen things. There's a pandemic. We're in the middle of a pandemic. And that was a totally out of left field. So who could have accounted for that? All right, folks, if we don't have any other questions, we've been on for almost an hour and a half. So I'm going to wrap it up. Be sure you go to pandemicinvesting.com and get your free mini book. Definitely do that. We'll be back with another podcast tomorrow on the Creating Wealth Show. And by the way, I have a bunch of other podcasts. If you're not listening to those, the Holistic Survival Show has been really popular lately. And of course, the Longevity and Biohacking Show is always another really popular show of mine. But definitely check those out. But Creating Wealth Show is published 5 days per week, 5 days per week. You know, I hate how the camera is always backwards. 5 days per week. Now Stephanie's saying she can't hear anything. Okay, I'm unplugging the headset. So we'll be back with another podcast tomorrow. And if we didn't get to your question today, please reach out to us through jasonhartman.com, and you can fill out any web form, and we'll be happy to take any of your questions then. So thanks again for joining me. And until tomorrow on the podcast, happy investing to everybody. Have a great Sunday, everybody. Thanks for joining. Bye.